I don't know much about whole life insurance. I can't say for certain whether it is a good choice for you or not. But what I'd like to do is show you how to apply your knowledge of IRR to contradict one particular claim that may be made by an insurance salesperson. Imagine you're given the following proposal. Let's go through these one at a time and see if we can identify where the most outrageous claim is. 15 years of $1,000 per year premiums. Well, if you have some money saved up, or if you have enough money from your job that you want to invest, this is not particularly outrageous. 40 years of $800 a year tax-free is also not particularly outrageous. Because of the magic of compounding interest, it is completely reasonable for a company to be able to offer you something like this. And yes, it can be tax-free because of the way whole life insurance works. A death benefit is essential to a whole life insurance policy. For my case, I'm going to exclude it because I find that as an investor, I don't care too much right now about a death benefit. 6.15% IRR is pretty good. You should compare that to the yield or the rate of return annually to any stock that or bond or mutual fund that you may be interested in purchasing. Those numbers can be compared directly, or you might compare it to the S&P 500, which has an average return of 9.8% over recent years. But the fact that this is guaranteed, or the claim that this is guaranteed, makes 6.15% relatively attractive, because of course the return, the 9.8% return from the S&P 500 is not guaranteed, and there's a lot of volatility. In fact, whole life insurance can't really give you this kind of guarantee because it will be dependent on things like the dividends that the company is paying you, or the internal loan interest rate that you must pay in order to get out your money. But upon some investigation, you might be convinced that 6.15% is the right number. Your salesperson might say, well, what we did to calculate it was we took this $800 per year, tax-free, and we divided it by a number to adjust it because we're giving you tax-free money. Any other investment, you'd have to be paying taxes on it. So you assume some tax rate, you divide it by that factor, and then you take this new number and you apply the 4% rule. This is a rule of thumb that says 4% is a safe withdrawal rate for any account generally, although I believe this was based on, using the S&P 500 to do the calculation. It was some study. So 4% has become sort of a rule of thumb, and it says you can safely withdraw 4% of the total money that you have invested every year, forever, and you won't run out. So you must divide this annual amount you want to get by the safe withdrawal rate to determine what total starting money you need to have in order to make 40 years of withdrawals. And everything that I told you is essentially correct, but The problem is when you use that in an IRR calculation. Let me demonstrate. So here we have 15 years of $1,000 premiums, as was stated in the proposal. We wish to compare or adjust the promised value in this whole life insurance as an investment. We need to adjust it to compare it to what other investments might be able to give you. So we start with the $800 a year that you would be able to get every year. Well, not actually every year, but for 40 years every year. And then we assume some tax rate. Let's assume 20% tax rate. So that means that we want to get some number where after you take out the tax, it's equal to $800. To get that number, you divide by 0.8, which is 1 minus the 20%. And this, oh, I didn't put the equal sign. This turns out to be $1,000. Okay, and then we make one final calculation. We say, okay, you need to be able to withdraw $1,000 every year. In order to do that, $1,000 needs to be 4% of the total money you have in the account. Because of the 4% rule, that would make sense. Okay, so to figure out what that number needs to be, that big number in your account before you start taking money out, you divide by 4%, or 0.04. Okay, so this is saying, if you want to compete with this whole life insurance policy that we're offering you, you need to find something where after 15 years of premiums, you have $25,000 so that you can apply the 4% safe withdrawal rate and get $1,000 out every year. And then you're going to have to pay 20% tax on it, which equals $800, which exactly matches the proposal. Seems reasonable, right? And then if you use the IRR formula here, you see, perhaps they weren't lying. Even though this sounds a little bit too good to be true, I just got the same number that they got, 6.15% IRR. And perhaps it's not guaranteed, but I trust this company. I think 6.5% sounds great. Okay. But don't forget that these cash flows don't actually accurately represent exactly what you're getting from your life insurance policy. You're not getting one lump sum payment of $25,000 after the end of your premium. For one thing, if you did, you'd probably be paying more tax than just 20%. Well, maybe $25,000, you could still pay 20%. But generally, taking out money in one lump sum means you're going to have a big number to report on your tax return, and you might end up in a higher tax bracket. Ultimately, the point is this is not the right sequence of cash flows. You want to calculate the IRR on the actual sequence of cash flows. And I know it's annoying because we're dealing with a total of 55 years here. It's going to be tedious to write it all out, but we should do it anyways. So here we have 15 years of $1,000 of premium. And then this should be 40 years all the way up to year 55. Yep, that looks right. Okay. Now, we have $800 here. That's the proposed amount of money that we can take out per year. But we want to get an IRR that is in the same units, that is comparable to an investment that we can get out there in the wild. Because in the wild, you have to pay taxes. In whole life insurance, you generally don't. So we do want to make the adjustment where we say it's $800, but we adjust it for taxes. So you'd have to get $1,000 out in the wild to equal $800 tax-free. Okay, after we've made that adjustment, then it's safe to calculate the IRR, right? Copy everything down. These are the cash flows that we'd be looking at. Let's calculate the IRR. Should be the same number, right? Oh, so one little fun fact about the IRR formula. If you get a small number, sometimes you have to put comma 0, and then the formula will work. Whoa, 3.95% IRR. That's not what we expected. We saw in the proposal that the IRR was 6.15%, but in fact it's only 2/3 of that. It's 2 percentage points lower. Well, that's the problem. You shouldn't use a rule of thumb when you have all the information, you have all the details, and you are advanced enough to understand the IRR formula. When you have all this information, you don't need to use a rule of thumb. You should just do the calculations by hand and look at the raw numbers. Otherwise, you might be fooled into believing that you're getting a better rate of return than you actually are.